Statement of cash flows. Good quality questions that you can expect on your exam. When preparing the statement of cash flows, companies are required to report separately the operating cash flows, investing cash flows, and financing cash flows. So the question says companies are required to report separately as operating cash flows all of the following except. There are three options given, and one out of these is the odd. Companies are required to report separately operating cash flows. Out of these four, three will be operating cash flows, while one will not be. So let us see these one by one. Interest received on investments in bonds, it is an operating inflow. I'm going to write it as O plus. Operating inflow here means GRR walaikum assalam. Interest paid on company's bond, it is an operating outflow. Cash collected from customers, of course, it relates to your operations, it's operating inflow. But look at this. Cash dividends paid on the company stock. Explicitly, clearly discussed yesterday that dividends that you pay to your shareholders, whether they are preferred stockholders or the common stockholders, it is a financing outflow. So make sure you understand this well. So that makes D to be the correct option. Correct. Next. All of the following should be classified under the operating sections in a statement of cash flows, except. Answer, no. We discussed yesterday, and let me show you. Let me show you. This is important. All right, next. Let's read it again. All of the following should be classified under the operating sections in the statement of cash flows, except one. Depreciation expense, it is an operating cash flow item. You need to add it back to your net income. That's per the format. Decrease in prepaid insurance, added in or deducted in net income. You know the what is to be added and deducted. We'll discuss this later. Decrease in inventory, A, B, and D. These items are adjustments in your net income. So they are part of your operating cash flows. Purchase of land and building in exchange for long-term note. It's a non-cash transaction. Absolutely, Clark, you're right. And it is neither reported in operating, financing, or in investing activities. It is reported outside the statement of cash flows because it involves no cash inflow or outflow. So basically, it's a non-cash transaction. Next, here we go. Okay, the question says a company entered into the following. Let me erase this up first. Okay. Company entered into the following transactions during the year. Purchase stock for $200,000. When you purchase stock, not your own stock, some other company stock. When you purchase bonds or you purchase stock, it is an investing outflow, I negative. Purchase electronic equipment for use on the manufacturing floor for $300,000. This is again an investing outflow. Paid dividends to shareholders of the company in the amount of $800,000. You have paid dividends to your own shareholders, and remember, under the US GAAP, the payment of dividend is reported as a financing outflow. It's financing outflow. So the question says the amount to be reported in investing activities section of the statement of cash flows is going to be $500,000. Absolutely right. That makes C to be the correct option. And C it is. Okay. To calculate cash flows.
I had a question there. It should be negative 500,000.
Yes, you are right. In some questions, you will put parentheses around the number indicating a negative figure. Here, you just need to point out the amount without the sign, right? The absolute amount in dollars. So yes, it is negative $500,000, but since there are no parentheses, so this is the only option we are left with.
Okay.
Okay.
Thank you.
Welcome. To calculate cash flows using the indirect method, which of the following items must be added back to the net income? I'm sure you would have understood the complete format of cash flow. Depreciation expense is a non-cash expense. Absolutely, Clark. It is added back. Amortization of bond discount is added back. Loss on disposal is added back. These are non-cash items, so they need to be added back. Interest income, it is already included in net income, so there is no adjustment for this. Revenue is already included in net income. No need to do this. Marketing expenses is an outflow and it is already adjusted in your net income. This is something you have to add back so as you can move from your accrual-based net income to the cash flow from operating activities. Next, net income was $3 million for the year ended December 31st. Okay. Additional information is as follows. What exactly are we looking for? The net cash provided by operating activities in the statement of cash flows for the year ended December 31st should be. Okay. Now, this is your net income. Take this as a starting point. $3 million. This is your net income, and we need to make some adjustment. Gentlemen, please be with me while I go along. Depreciation on fixed assets. Depreciation is added back so as to reverse the impact of non-cash transactions. 1.5 million is to be added. Then gain on sale of land, gain is deducted, loss is added. I hope you would remember from the previous class. So since it's a gain in the net income, it's a non-cash gain, so you need to deduct it. Now, I would like to ask a question. Here. Loss on disposal is added. Makes sense because loss on disposal is a non-cash charge. How come we are deducting the gain from sale of land from our net income? We received cash. Gain was received in cash. Can anyone tell me why are we deducting this $200,000 even though we have received it?
Because it is already added in the income statement.
It's already added in the income statement, but since we have to report, anybody else, Ashar, that answer needs little qualification. Anybody else? Hasib, no, it's not revenue. That's not the reason why we are deducting it. Anybody?
It's a gain from sale of land, investing activities.
Absolutely, answer. Absolutely right. Since it's a gain on investing activities, so we remove this 200 gain from operating section and we add this 200 together with the total amount received in our investing section of the cash flow statement. Absolutely, Vakas, you are right. So since this $200,000 is the gain, we remove it from the net income and we include it in the total amount received on the disposal of land. So this 200,000 will be included in the total amount we received when the land was sold. So that's the reason we remove it from here and consider the total amount in our investing inflow. So that's it. Then increase in accounts payable. When you delay making payment to your accounts payable, you hold on to cash, you delay the payment, effectively, you are increasing your cash flow, delaying the payments to your accounts payable, delaying accruals. That means it's an inflow. And finally, dividends paid or preferred stock, it is not an operating inflow or outflow. It is considered as a financing section. So let's add these up. I think someone has calculated the number. What was it? 4.6.
Sir, I have a question.
Yes, please
I have
ask.
a question here.
Sure, ask.
This gain of 200,000, we are deducting from operating activities.
Yes.
And that the same gain we will add back in investing activities.
Yes.
Cash flow. So if we don't adjust this, because we are doing contra entries, na? First we are deducting and then
let me tell you. First of all, this 200,000 gain is included in net income. So what I'm going to do, I'm going to deduct this 200,000 from my net income in order to determine my cash flow from operating activities. I have received a total of, let's say, I have received a total of $700,000 when I sold my land. Now, this $700, the whole of it, it will be reported as a cash flow from investing activities. Now, if I do not deduct this 200 here, the whole amount, inclusive of gain, is already included in the investing activity inflow. I need to remove this gain from here, because if I don't, this gain is double counted. One as a part of investing activities, another it is already included in net income. So I need to remove this gain and consider the full amount in my investing activity.
So your voice is cutting.
Let me explain. See, we have sold the piece of land for $700,000, right? This amount includes this 200 gain. If we do not deduct,
your voice is gone again.
Just a minute. Okay, next. Roy's company had the following transactions during the fiscal year ended December 31st, year 2. Account receivable, there's a lot of information. Let us first read exactly what is required, so we know from which viewpoint do we need to look at the question. Required. Roy's company uses direct method to prepare its statement of cash flow. Direct method means you take the gross inflows and the gross outflows from operating activities. So the company uses the direct method to prepare its statement of cash flows at December 31st year. 2, the interest paid to bondholders under the US GAAP. Interest paid to bondholders, it is reported as what? It is reported as a part
Financing.
No. Again, let us come back again. This is what we just discussed a little while ago, that under the US GAAP, interest paid is reported as a part of operating activities. Here it is. Interest paid, interest received is a part of operating activities, right? Interest paid or received. Dividend received is an operating, but dividend paid is financing. So this fine point needs to be remembered. So interest payment is a part of operating section, and this is the only option. Operating section as a use or outflow of cash. So we didn't need to read the whole question. Just this last statement was enough for us to get the answer. Same question, but this time you need something else. Now let's read the whole question. Account receivable decreased from 115 to 100,000. If account receivable has decreased over the period, effectively it's an inflow. They would have paid you. Roy's board of directors declared dividends on December 31st, year 2 of 0.05 per share on 2.8 million shares. This was the dividend declared, payable to shareholders of record on January 31st, year 3, which means this dividend was declared at the end of the year, but it was paid next year in Jan. So it results in no cash outflow. Sold a truck with a net carrying amount of $7,000 for $5,000. You sold a truck which had a book value of $7,000 and you sold it at $5,000. Clearly, there is a loss on disposal of $2,000. Cash, that's reporting a loss of $2,000. Fine. This is what you got. This was the book value. So there is a $2,000 loss on disposal. Paid interest to bondholders, $780,000. The cash balance was 106 on December 31st, year 1, and 284 on December 31st, year 2. Okay. Now, Roy's company uses the indirect method to prepare its year 2 statement of cash flows, where we start from net income. It reports what? Addition of 2,000 in the operating section for 2,000 loss on the sale of truck. I hope you would remember any loss on disposal right here. This one, loss on sale of plant asset. The loss on disposal is added to the net income. So this is the one. Addition of 2,000 in the operating section for 2,000 loss on the sale of truck. This is the right answer, we know, but let us see. Let us see. Yes, Salman, A is the right option. Why not BCD? Let us discuss. Source or inflow of funds 5,000 from the sale of truck in the financing section. Disposal of long-lived assets. It's a part of your investing inflow. Right? So this is wrong, not financing. Use or outflow funds 140,000 in the financing section representing dividend. The amount is correct. It is a 0.05 dividend per share, 2.8 million shares. So the amount is 140, but there is no cash outflow. We have just declared the dividends. Dividends would be paid next year, 31st Jan. So there is no outflow for dividends. So this statement is wrong. What about the last one? Deduction of 15,000 in the operating section representing the decrease in the year-end account receivable. I'm sure all of you know dividends, when the account receivable balance falls, that represents an inflow. Your account receivable fell from 115 to 100,000. So it is added to the net income, not deducted. Let me take you back. Here it is. Decrease in account receivable. The very first line indicates that when there is a decrease in account receivable, it is basically an addition to the net income. Yes, Rajesh, you are absolutely right. So now we are convinced that we have selected the right option. Convince yourself why the right is right, why the wrong is wrong. Now, this is a fantastic question. Last part. It says the total cash provided by operating activities plus cash provided by financing activities and investing activities is what? We have very limited information. And the question asked, please, those of you who have already done this question, please stay silent, guys. I just want others to just give it a try. We need to find out the cash from operating activities, cash flow from investing activities, and cash flow from financing activity. I need their net total. But information is very, very rudimentary, very basic information is given. How can I find all these? Anyone who hasn't done this question, how can you find the sum of these cash flows from this given information? Let me give you a hint. You have the opening balance of cash, OB, and the net increase in cash during the period is sum of these three things: cash flow from operating, cash flow from investing, and cash flow from financing. So opening balance of cash plus adding all these inflows will give you the closing balance of cash. So if you have the opening and closing, that means things can work out that way. You already have the opening balance given to you as 106. You have the closing balance given to you. So if you just work back OB and CB, you will be able to find this chunk, this bulk of cash flows, all these together. I hope you understood the point. When you're given the opening balance and closing balance, just take the difference and you will be able to calculate the sum of these three categories of cash flows. So most of you are saying 178 and at 178. The difference between these, in fact, is the cash generated by operating activity. So just let's go for the reconciliation. If this is so, this was the opening balance of cash, 106,000. This 178 is the cash generated by these three activities. So the closing balance should be equal to 284. This is the mathematical equilibrium for the cash flows. Absolutely, Salman, you're right. So that gives us, so this is the way you can solve questions. Remember, some questions will be twisted. They will test your alertness, your preparation, how strong you are, how well you are prepared. So remain calm and composed. You will get it. All right, now this is a good one again. First, read the requirement. The net cash flow from investing and financing activities that should be presented on the statement of cash flows for the year ended December 31st, respectively. We need to find out the investing and financing cash flows numbers. Let us go through each one given separately. The following information was taken from the accounting records for the year ended December 31st. Proceeds from issuance of preferred stock F. This is the financing inflow. Issuance of stock. Proceeds, dividends paid on the preferred stock of company F. It's a financing outflow, F negative. Then bonds payable converted to common stock. Conversion of bonds into stock, it results in no cash inflow outflow. All right. Then payment for purchase of machinery. This is investing outflow. When you acquire a long-lived asset, any payment made for that is the investing outflow. Proceeds from the sale of plant building. This is investing inflow. I plus. 2% stock dividend on the common stock. Common stock dividend doesn't involve any cash. And finally, the gain on sale of plant building. This gain is deducted from operating activities. So this is not what we are looking for. So let's just bring it up what we have. We have two investing inflows and outflows. One is the 500,000 outflow and 1.2 million inflow. And for financing, we have 4 million inflow when you issued the shares and 400,000 outflow for the payment of dividends. Remember, the dividend payment, whether for preferred stock or for the common stock, it is considered as a financing outflow. So yes, you're right. It's 700,000 for investing and 3.6 million for financing. So that would make A to be the correct option. This is how you segregate cash flows. Next. An entity reported net income of $150,000. This is your net income, $150,000 for the current year. Changes occurred in several balance sheet accounts during the current year. Okay. The question says, in the current year cash flow statement, the reported net cash provided by the operating activities or cash flow from operations is equal to what? Now, guys, listen to me very carefully. It's a good question. We make many adjustments in net income in order to arrive at our cash flow from operating activities. We have been given three. Follow my instructions closely. It says investment in stock, all of which was acquired in the previous year, carried on the equity basis. We have an investment which has increased by 5,500, and it is an equity-based investment. We have equity method in your financial reporting. We'll discuss it in detail. The idea you need to know, that your investment account had an opening balance of $100,000. Let's say it has increased by 5,500 during the period. Your equity-based investment account increases when you add up accrual-based income. Let's say I have a 30% investment in Ansar's company. 30% is quite a sizable investment. So when Ansar earns some income, he doesn't pay me anything, but I add 30% of that income to my income statement. I didn't receive any cash. So under equity-based investment, 30% of income earned by Ansar is added to my net income. So ask a question to yourself, did I receive any cash? Maafi. If you have received no cash, then this 5,500 non-cash income must be excluded from your net income in order to reach to the cash flow from operating activities. It must be deducted. Then I hope you would remember from the format given, if there is any amortization of bond discount, which is a non-cash item, it is added back. And if there is amortization of bond premium, it is deducted. This was the reason why the format was given. So this premium amortization must be deducted. So you need to write this 1,400 negative. Then deferred income tax liability. You have income taxes in your syllabus. Just for now, consider it's a liability which has increased. When the liability increases, you are in a way delaying the payments, which effectively increases your inflow. Right? So remember, increase in liability mean you didn't pay. When you don't pay, effectively you are increasing your cash flow. So if you add all these, you should get a total of A. Salman says A it is. Right? So this is how you need to analyze the given information. Again, a company's year-end income statement shows the following: revenues, selling and general expenses, including this much depreciation, interest expense, gain on sale of equipment, income tax expense, including a deferred tax expense of 30,000, and net income. This is our starting point. You start from net income and make some adjustments for working capital, non-cash transaction, and you end up with the cash flow from operating activities. Okay, during the year, non-cash current assets. Can anyone tell me what is a non-cash current asset? Non-cash current asset. What specifically he's referring to? Non-cash current asset. Come on, guys. CMAs. It is account receivable. It is probably inventory, or it could be prepayment. These are your current assets, but they are non-cash. So there is an increase in current assets in account receivable, inventory, and prepayment by $100,000. Okay. And current liabilities increased by 150. These are two important pieces of information. Let us now calculate the cash flow from operating activities. We have to find out CFO. How do we do that? You need to start from net income, and net income is given right here. That's my starting point. And I will make some adjustments as per the format that you have already with you. I need to first start from the beginning. Revenue, nothing. I need to take this depreciation. Depreciation must be reversed, must be added back. I need to add this $200,000. Okay, done. Then interest expense, it is already deducted. I don't need to make any adjustment. Gain on sale of equipment. Remember, the loss on disposal is added and gain is deducted. I'm sure this is what we discussed in detail yesterday. So this gain, $40,000, needs to be deducted from net income in order to determine our cash flow from operating activities. Done. What about the income tax expenses? Income tax expense charged to your income statement includes a $30,000 deferred tax. What does it mean? It is an expense which you have charged to your income statement, but you are not paying it right now. You are deferring it for the future. So it's an expense charged to income statement, but has not yet been paid. Since it has not yet been paid, so you need to, what you need to do with it? Think about it. Just try to contemplate and give me what you're going to do with this. This $30,000 deferred tax you didn't pay. This $30,000 deferred tax you didn't pay, but it is included in the net income. What are you going to add? Yes, absolutely. This needs to be added, right? Because we didn't pay. Correct, boss. You're absolutely right. So tax treated And then what else? These two items now. These two items need to be treated. Your account receivables inventory prepayment increased by 100,000 and your liability increased. Let us discuss what we're going to do with it. Now, if your account receivable inventory prepayment have increased over the period, which means your customer didn't pay, your inventory didn't convert itself into the cash. So basically this 100,000 increase in account receivable and inventory, it is an outflow. You must deduct. Absolutely, Gauss. You got it. You got the idea. And your current liabilities increase, which means you delayed the payment to your suppliers, to your accruals. So this delayed payment effectively is an inflow. Please, somebody add all these up. You will be able to calculate your cash flow from operating activities. Ahmad says D, and D it has to be. See, this is how you identify each element and then go about. If you have understood the format well, you would know what is to be added, what is to be deducted. It's a good question again. A typical question, or I would say this is how you prepare operating cash flows in actual practical accounting. You have the last year's account receivables, current year, and let me show you how you do it. All right. An accountant has gathered the following information to prepare the statement of cash flows for the current year. Net income is given as 456,900. Okay. What are we required to do? You need to find out the amount of cash provided by operating activity. I told you, you are not going to draw up the statement of cash flows. You need to be able to calculate the segmental cash flows, parts of it. Okay, so net income is 456,900, starting from net income 456,900. It includes 45,600 depreciation, which is of course deducted from your revenues and operating expenses. Depreciation needs to be added back. Depreciation needs to be added back. So 45,600 will be added back. Done. Done. The company issued 300,000 of dividends this year. This is financing outflow, nothing to be taken from this. And new building, 275,000 was acquired. This is investing outflow. We just need the operating activities. The balance sheet from the current period and prior period included the following balances. Account receivable 56,860 last year, and it has fallen to 45,300. If your account receivables have fallen during the period, clearly they have paid you. Decrease in account receivable indicates that they have paid you. The difference between these two numbers is 11,560. Needs to be added because decrease in account receivable effectively represents an inflow. 11,560. So I'm going to write it this way. Account receivable decrease is an inflow. Done. Accounts payable, they have fallen also. Account payable have fallen, which means you would have paid them. Your accounts payable opening balance was 12,900. Now it is 10,745. The difference between these two is 2155. Decrease in accounts payable effectively represents the outflow. 2155. Accounts payable decrease is an outflow. Lastly, your inventory balance 186 has gone up to 194. So when your inventory balance goes up, that means increase in inventory, that is an outflow. So if you calculate the difference between these two, the difference is going to be 7620. So you're going to deduct 7620. This indicates your inventory has gone up. And I think that's all. That is all. So if you do all the network, it says Rajesh is 504, 285. And that's correct. That is the right option, A. The most commonly used method for calculating and reporting the company's net cash flow from operating activities on the statement of cash flows is either direct method or indirect method. In my professional accountancy career, in every business I work for, I always invariably use the indirect method. And this is exactly what you guys would be doing. Indirect method is convenient. If you follow the direct method, which is preferred by IASB as well as FASB, both American and the international reporting standard, they prefer direct method. But the drawback is that if you follow the direct method, you will have to prepare a reconciliation. Now, this is something I would like to tell to those who didn't attend yesterday's class. If you decide to follow the direct method, which means you take all the operating inflows and outflows, you have to prepare a reconciliation between your net income and cash flow from operating activities. This reconciliation, gentlemen, this reconciliation is the indirect method. So why don't you just simply go for the indirect method rather than just going the direct method, then preparing the reconciliation? So this is the very reason in 100% cases I have seen this method being followed. Salman, I appreciate that. So that's good. But in practice, you will do this, I'm sure. Yes, because as I said, that most of the questions, I should say all the questions, that the computational questions, they are all indirect method based. Yes, boss, you are right. There are 3 sections to cash flows: cash flow from operating, cash flow from investing, and cash flow from financing. It's only the operating cash flows that is direct and indirect. Rest of these are the same. Operating cash flows can either be prepared using either direct or indirect, but investing and financing, they are the same. So please keep that in mind as well. Okay, moving on. A company has recorded the following payments for the current period: purchase of investment stock. Purchase of investment stock. You are not buying your own stock, you are buying stock of some other company. You buy bonds, you buy debentures. So this basically is an investing outflow. Let me write it as I negative. Investing outflow. Dividends paid to shareholders, of course, we pay dividends to our own shareholders. It is financing outflow. Repurchase of the company stock. When you purchase your own stock, this is financing outflow. So please compare these two. In the first line, purchase of investment stock, this is investing outflow. You are purchasing stock of some other business. And when you purchase your own stock, called treasury stock, it's a financing outflow. So it says the amount to be shown in the investing activity section of the statement of cash flows. Investing section would show only 300,000. So that would make C. Rajesh, you're absolutely right, boss. Correct. That is the answer. Now, a company has the following payment recorded for the current period: dividends paid to the shareholders. Let us mark these. When you make payment to of dividends to your shareholders, it is a financing outflow as per the US GAAP representation of financial statements. Interest paid on bank loan, it is an operating outflow. Purchase of equipment, this is an investing outflow. Now, what the question says: the total amount of the above to be shown in operating activity section of the statement of cash flows, just 250 only. C, correct. A company has recorded the following payment for current period. The amount to be shown in the financing section of the statement of cash flows. Let's mark each one separately. Interest paid on bank loan, it is an operating outflow. Dividends paid to shareholders, it's a financing outflow. And repurchase of company's common stock, it is again a financing outflow. So the combined financing outflow, Vikas, absolutely right, it is $600,000. So that is the right answer. Now, this is a good question. As I said, that you are going to get at least a couple of questions on cash flow statement for sure. That's the historical record, because a very important topic from exam point of view, and professionally also when you are interviewed, or maybe when you're writing test for a job, this area of financial reporting, the cash flow statement, invariably is a part of your test. So make sure you understand it well. Now, let's say if the question comes on the essay section, you don't have to draw the statement of cash flows. You just have to calculate some component parts. The asset type might require you to calculate the cash flow from operating activities, which you can do in a paragraphic form. No need to draw the formats and so on. So let's just read this question first and take it as an essay type. Consider this is an essay type. Same question for 39, 40, 41. So consider this is an essay type and you are required to just calculate the cash flow from financing, investing, and operating. So let us first read the components and then mark them accordingly. Selected financial information for Christina Company for the year just ended is shown below. Net income, this is our starting point. This is operating plus, that's we take different numbers and add or deduct from this. Increase in net account receivables. If your account receivables have increased over the period, if account receivable balance has gone up, that means it needs to be deducted from operating cash flows or net income. Decrease in inventory, when inventory decreases, that basically is an inflow. Increase in accounts payable, when the payable balance goes up, that shows that you have held on to the payments. So this is basically addition to the operating cash flows. Depreciation expense is a non-cash item to be added. Gain on sale of available for sale securities, this is deducted from operating activities. Then we have dividends, the cash receivables from issue of common stock. Cash receivable from the issue of common stock. This same question has been solved in Wiley, and it has been solved incorrectly in Wiley. Gleim has solved this question correctly. Please mind this word. It is cash receivable. You may have issued the share, but the money has not yet been received. So this $800,000, apparently it appears, Vikas, the answer you have calculated is wrong. And for this very reason, it is wrong. You have considered this as a financing inflow, but it is not. Why? Because cash receivable, not received. Please mind the word. It is receivable. We did not receive it. It is due. Yes, Ahmad, absolutely right. So this is the cash. That's the mistake what Wiley has done. Wiley has simply considered it as a 800,000 plus. Yes, so it has not yet been received, so you're going to ignore it. Cash paid for dividends, yes, this is the financing outflow. Cash paid for the acquisition of land, this is the investing outflow. And finally, the cash received from the sale of available for sale securities, this is your investing inflow. We have marked every item clearly. Now let's say if your asset type says you need to find out the cash flow from financing activities. What you're going to do, you're simply going to write CFF or cash flow from financing activities. And what you have, you just have a single number, just write it the way it is. No formatting required. This is the single outflow, $80,000, and that perfectly matches with your option B. Right?
Sir,
Ji, puchiye.
sir, I have a
Ashwin.
question.
Please.
Cash receivable from the issue of common stocks.
Mhm.
So it will come under receivable section, right? So it will increase our receivable. So
Mhm.
that can be deducted from operating activities or not?
No. See, there is basically no change in receivable. This is the balance created at the end of the period. And the amount receivable from your stockholders, it is not reported as a current asset. We have just issued the shares. There's basically no entry because just shares have been issued. No money has yet been received. So this is receivable against the shares issued to the common stockholders. Such shares are not permitted in Pakistan. In Pakistan, shares are either fully paid or they are not issued. But in the US and UK, the shares can be issued partly. You have issued the shares and you keep on receiving the money share. Calls in arrears. This is called calls in arrears. So this is not included in your CMS syllabus. So you just need to remember it is receivable against common stock, not in the books. So basically it is, you're not going to consider it as an inflow, right? And not consider it as an operating inflow. You can't put it in an operating inflow because in operating inflow, we have account receivable for trade. This is not a trading inflow, right? So you just ignore this amount. So that
we not treat it as the assets, sir? All scenarios?
No. It is just that stock has been issued, but cash is not received yet. Even it is receivable, but not reported as an asset on the balance sheet.
Okay. So means we should ignore always if it comes.
Yes. Receivable against common stock is ignored.
Okay, sir.
Next part is cash flow from investing activities. We have highlighted all these parts. Investing, I think there are just two items relating to investing. 1.5 million is an outflow and 2.8 million is the inflow. If you take the net number, 1.5 and 2.8 is going to be a positive 1.3. So that would make Salman A to be the correct option, right? So let's say if this is the essay section of your exam, what you're going to do, you're going to write the cash flow from investing activities proper, and you just write these two numbers. No need to write the text here. Just write these two numbers and it's sufficient. Write 2.8 million first. It's an inflow on available for sale, and you deduct 1.5 million. And there you go. This is how you lay down your working on the essay section of the exam. No columns or formatting is required. So that makes A to be the correct option. Now, last part requires some working. Now, let's say the question says you need to calculate the cash flow from operating activities or operating cash flows. So you are going to bring in all those items marked as O. Cash flow from operating activities. Simply write the numbers. You start from net income, that is 2 million. You deduct this 300,000, I'm going to write this is 0.3. Then you write the full numbers, 2 million, then 300,000, then do it horizontally in a paragraphic form. Then you have decrease in inventory, which is basically an inflow, 0.1 million. Then you have increase in accounts payable. You didn't pay, effectively is an inflow. Depreciation expense to be added back. It's a non-cash transaction. And finally, the gain on available for sale securities. Remember, loss is added and gain is deducted. So if you deduct this 0.7, I think you should get your answer. Please, someone solve this. Someone has done. Waqas says D. And I guess that is the right option. That is the right option. Correct, Salman, right. Waqas, you're right. So this is how you do it. You don't have to do formatting. So you will not be required to draw up any statement of financial statement. You just need to know how to do some segment, some part of the financial statement, maybe calculate operating cash flows, or maybe calculate the cost of goods sold or the gross profit, some parts, not the complete financial statement in its own right. So that gives you D to be the correct option. All right, then. Again, for the fiscal year just ended, an entity had the following results. We have been given different items. We need to find out the net cash flow from operating activities. So you start from the beginning. You start net income, start from net income, that is $920,000. To this, you add depreciation. It's a non-cash expense, 110. Increase in accounts payable. If account payable balance has gone up, that means you have delayed the payment. Delaying the payment effectively is an inflow. So you need to add it back. 45,000. Right, then increase in net account receivables. Increase in account receivables, effectively they didn't pay, so effectively it represents an outflow, 73,000. And increase in the deferred tax liability. Increase in liability means you didn't pay, you held on to the cash, so this effectively is an inflow. So do all these, you should get your answer. D. D. And D it is.